Greetings, and thanks for tuning in to this brief message on what I believe is one of the most compelling investment opportunities for this generation of investors. My name is Roger Conrad, and I'm co-editor and publisher of Energy and Income Advisor, the most concise and comprehensive resource for successful investing up and down the energy value chain. I produced a short video titled Table Pounding Buy in America's Least Loved Sector. I'll show you how to view it in just a moment, but first, a bit about the opportunity in front of us. I've been pointing investors like you to the best energy stocks since the 1980s. In fact, the first stock I bought out of business school was an energy stock. By the way, it currently pays me more in dividends annually than I initially invested. I can tell you that truly table-pounding buy opportunities like the one we have now basically come along once a decade. And you can bet I'm stepping up to the plate, both for my clients and personally. You probably already know that energy is a business that moves in cycles. When the price of oil and natural gas are low, so are energy stocks. And when prices rise, so do prices of energy stocks. Rising prices encourage demand destruction with conservation and development of alternatives. They also encourage more supply, which combined with reduced demand eventually brings down prices. That's what happened to the energy sector the past several years, and the fallout hasn't been pretty. Falling share prices, dividend cuts, bankruptcies, we've seen it all since oil prices began their fall from over $100 a barrel to a little over $26 in early 2016. Most of the damage occurred in the first couple years of the downturn, but much of the pain has actually been felt after the bottom was already in for the commodity. The dividend cuts we've seen the last 12 months for pipeline companies, for example, surprised a lot of investors. And the result is energy sector sentiment right now is probably the lowest it's been for the cycle. That's particularly true of master limited partnerships, or MLPs. The gloom right now is so thick that nearly 3 dozen MLPs in our comprehensive coverage universe have yields of 10% or higher. A yield that high is a clear sign that investors expect a dividend cut. The irony is, the energy midstream business behind these MLPs is actually the healthiest in at least 5 years. Sure, we're still a long way from a return to $100 oil. There are certainly many catalysts now to take us there now, from the implosion of Venezuelan production to still rising global demand. But the real catalyst for energy stocks, including MLPs, is the fact that management teams have spent the past 4 years cutting their fat, risk, and debt, and are focused as never before on the most profitable segments of their business. As is always the case when the cycle turns higher, the weak have been weeded out. What are left are robust companies with a clear path to low risk and powerful growth. And that's always a formula for big investor returns. And here's something that may surprise you even more. Despite what's still very bleak investor sentiment for energy stocks in general, the technical picture has actually turned bullish. This spring, my co-editor, Elliot Gu, and I attended the MLPA Annual Financial Conference, a forum we've attended for well over a decade. We like it because we're able to gain insights from interacting directly with MLP executives, as well as with general observations, like how many people are attending, how many MLPs are presenting, how long are the lines for coffee, which, as funny as it sounds, is actually a pretty good indication of how interested the analyst community is in the sector. Some years we've had to stand in line quite a while for a cup of joe. This year, there was never a wait, whatever the time. Fewer analysts, fewer MLPs. Classic signs of a market where sentiment is at low ebb. Even the executives were decidedly downbeat. From that kind of atmosphere, you'd have thought MLPs were plumbing out new lows. But the Alerian MLP index at the time was still 20% above its lows. 20%! Not even close to setting a new low. I've only seen the combination of favorable business fundamentals, improving technicals, and rock bottom investor sentiment a handful of times in my career. But every time I have, the result has been the same: a table pounding buying opportunity for investors that's never once failed to produce huge returns. The last time I saw it in energy was in 2009, coming out of one of the worst bear markets in decades. That's when Elliot and I launched an advisory dedicated solely to MLPs. And within a year, we'd seen gains of 100% and more in the household names we'd recommended. That's the kind of opportunity that we have now. Increasing business strength, improving technicals, rock bottom investor sentiment. Always the best time to buy, and that time is now. Watching my video, Table Pounding Buy, is the first step in tapping in to the coming energy bonanza. Please click on the link below to get started. So let's get started here. First slide here I've presented many times in presentations I've given to investment conferences and so on. It's a pretty basic graph of really could be applied to any commodity cycle, but in this case we're talking about energy. And it sort of simplifies things, I guess, a little bit. But if you look at the history of cycles and you look at the history of energy, it does tend to move in roughly these four phases. When we started with Energy and Income Advisor, which was back in 2012, we were kind of in that green area there. Prices were high, they were rising, demand was strong, supply growth was insufficient to meet demand, and capital spending of companies was very strong. So it was a very good couple of years there. But then we started to see, as we got into 2014, demand destruction. And by that I mean when you have the price of a commodity being so high that everyone who's using it starts looking for alternatives. They start looking for conservation, ways to conserve. And that started to happen to energy about that time. Another thing that really happened was the fact that prices were so high really encouraged a lot of supply, and particularly in the United States, where we really haven't seen significant growth in energy production in about roughly half a century. I mean, pretty much those of us who've been around since the middle of the last century anyway, our lifetime has been one where we've seen U.S. production continue to decline, the U.S. continue to increase the amount of energy imported. I remember Jimmy Carter and his in Sweater, the fireside chat, talking about we're not going to import one more drop of foreign oil, meaning basically that we were going to stop that growth in foreign oil. And a lot of things that the Carter administration tried to do on energy were revolved around that, such as increasing fuel standards, promoting what were then very, very nascent technologies in renewable energy and so on. And ultimately that a lot of those efforts kind of went away for a number of years because the cycle turned and things, converting to alternative fuels and so forth became a lot less attractive. But this is basically what happened when earlier this decade, and we started to see more supply come online in the United States, and particularly the advent of shale drilling technology, hydraulic fracturing, use of a lot of water and a lot of sand to get energy out of the ground that really wasn't possible to do economically even just a few years before that. So the real impetus for that, again, these high prices, and we started to really see things take off as in terms of production. So that was that yellow phase there, and that's one reason why we started talking about the end of the oil bull market back in middle part of 2014, and as we got into further into 2014 and got very much more I guess conservative with the picks that we had in our various in our various portfolios. So we got that kind of demand response to those higher prices in that yellow phase. Well, then we moved into a few years in that orange phase there, prices low and falling, and this is when we started seeing people starting to recognize that, hey, maybe a return to $100 oil wasn't going to happen so quickly. It really happened in several phases. There was one point where oil rallied up towards $60 a barrel after it had dropped so precipitously into the early part of 2016. Rallied towards about $60 a barrel. A lot of people thought it was going to really break out from there, but then it broke down again. So this is the kind of action that happens in that period. And eventually, the energy sector, energy companies began to take that into account in their capital spending. And we saw a lot of companies cut back capital spending. Some cases it was involuntary. Lenders and became less willing to open their wallets, and plunging stock prices made even publicly traded companies, larger companies, unable to issue new equity at favorable rates. So that definitely hurt because, of course, when revenues dropped, they had to raise more capital in order to keep those capital budgets going, in order to keep those production plans going. So we started to see that's kind of work its way into reduced production, and as a result, that, as always happens this time of the cycle, prices bottomed out. And now our view is now we're starting to see, moving into that blue area here of this pie chart. Supplies, today we got another report in on supplies, and showing a fairly tightening market. And that's been a hallmark, I guess, of the past year or so, and of the rally we've seen in oil prices in recent months. This has, of course, also been fueled by concerns such as what happens when all that Iranian oil comes off the market. Iran sanctions were lifted for a number of years, but that policy has been reversed by the Trump administration, and they put a lot of pressure on other countries doing business with Iran to also suspend trade and so on. So, we'll leave aside politics and everything like that, but as far as we're concerned with the oil market, this is bullish for oil prices. Not so bullish for companies that were doing business in Iran. Many of them have had to just basically pull up stakes and go, which is costly. Also forces them to reset their production plans. But it does make energy supplies tighter, and it makes energy that's produced elsewhere more profitable to produce. So that's very, very bullish for the industry. Obviously, the most affected companies will take the biggest hits to their bottom line. But even some of these companies, you look at a company like Total, which is a super major based in France, pulling up stakes there. They have plenty of other growth projects around the world to pick up the slack. So, a big company like that can, and that's a hallmark of super majors. And one reason I like these stocks so much is they really do make it through the entire cycle. And in fact, often they do better in those in that yellow and that orange, particularly that orange phase of the cycle. Because they're large, they have the reach, they have the downstream operations, they have the balance sheets. They can basically keep things going, take advantage of smaller companies' misery, if you will. But that's they do tend to do well throughout all these phases of the cycle. Other companies don't do so well in different phases of the cycle. It's very difficult for energy services companies to do well in that orange phase. It's also difficult for energy services companies to do well in that blue phase. When I mean energy services companies, I'm talking about companies that are involved in the actual drilling of energy, that provide technical expertise. They really do depend to a large extent on activity. And when activity is somewhat constrained, it can be hard for them. Of course, it doesn't apply to every company in that space. And just like the super oils tend to do well when other producers are not doing so well, the larger energy services companies can do well when others are, when the smaller ones aren't doing well. In fact, they tend to pick up more market share over in such times. But again, this is the kind of cycle that we're talking about here. It really does affect every energy company. It affects basically every energy company you want to buy. You know, in the green and even most of the yellow phase of the cycle there, almost any energy company does well. You know, rising tide raises all boats. So you can go and buy you know, an ETF and do quite well on any sector really of the energy business. But you get into the place where we are right now, you know, that doesn't really fly. And in fact, one of the things I want to just impress on you in this talk is that it's very important to be selective in this business, and that generally means picking your own stocks and knowing what it is that you're buying. It's quite a different world out there. I mean, I remember early in my career, pretty much the old guys in the business said, well, you know, energy prices rise. That's good for our energy stocks. Energy prices fall. That's not good. It's much more nuanced these days because you have that, again, a live production industry in the United States. And it comes down to even the fact that sometimes it's profitable to produce in some parts of the country and not in others. Places in Canada, for example, that are desperately in need of pipeline capacity to pipe out the oil and gas there. They're selling their energy in some cases 50% less than energy sells at benchmark in the United States. So, you know, again, it's very much a matter of being selective. But this is a general framework in which we're talking about energy here. And the reason we really see this as a table pounding buy is that the better companies, the companies we've identified, are right now in that blue phase, and we're really looking for them to really take off for us going forward. So interesting graph. I could talk about it all day, but I really want to move on here and to make a little bit more some of our points here. This is a graph here of the continuous futures of oil. So it's basically the 1 month price out of oil. Not the spot price, but this price actually tends to be a little bit more true in terms of what the energy sector is looking at when they're making decisions and so forth. It's an interesting graph in that it goes back about 5 years, and that's you can see that's a lifetime in this energy business. It's basically looking at that, again, referring it back to that pie chart, that circular chart earlier in the previous slide. You can see oil prices very high, over $100 a barrel, really up until middle part of 2014. They started falling. They hit bottom in early part of 2016. You can see is actually a double bottom, which tends to be a pretty favorable technical pattern. And then since then, they've been kind of ratcheting higher. The gain in oil itself has been quite astounding. You know, the bottom was $26 and change, and now we're at $70. So almost a tripling of oil prices over that time. Let's take a look at natural gas. So natural gas, which is the other big fossil fuel that's on the come in the United States, pricing really has not been all that bullish. Now, this is a longer term graph than the one I showed you for oil. If you look up in that top left-hand corner, you can see the dates that I used. This starts June 29th of 1990. And you can see, which is basically when natural gas began to be traded freely in the United States. So you had a market price rather than controlled price. And it really set off quite a bit of turmoil in the gas industry at that time. A couple of bankruptcies of major pipeline companies over that time. They worked their way through all of that, but there was a pricing system in place at that time, and when they changed the rules, it really burned those companies that were in that business. but we moved on from there, and you can see that gas, mainly because of demand, the price started to rise over that period. Now, gas is different from oil in another very fundamental aspect, and that is, up until very recently, it's been pretty much a local commodity. In other words, all the gas that's produced in the United States was basically consumed in the United States. Pretty much true also of North America. What's changed has been the advent of liquefied natural gas exports, and a number of countries around the world are trying to electrify their cities or rural areas and so forth. So there's a lot of people without electricity, and they're trying to do it without burning coal, because as China has certainly discovered, if you throw up a lot of coal plants, you burn a lot of coal plants, or a lot of coal in those plants, you use coal for heating, you have some pretty severe air, water, and even waste pollution problems. Gas is, of course, a huge beneficiary of coal's demise here in the United States, and I'll talk about that a little earlier. And I think it's only going to become that trend is only going to accelerate over time. One reason is just because gas has remained at this very steady in this lower price. Why has it come down from those high levels? Well, when it was going to those high levels, it was because demand was really picking up here in the United States, and supplies were getting more and more strained. That was actually a time when you saw a lot of companies building import facilities for liquefied natural gas. So the idea was we would import natural gas from countries like Qatar or off the coast of Africa and so forth to the United States. But then, of course, we got the advent of shale drilling, and it suddenly brought a lot of huge reserves into the realm of being economically able to produce. So really, as far as the price of gas goes, it's been in a bear market for the past 10 years for this reason, and even as demand has picked up. So natural gas is definitely not in a price bull market, but as this next graph shows, it's definitely in a bull market in terms of demand. And there are a number of uses that we're seeing gas really pick up. LNG exports. This is actually a graph from the Energy Information Administration via a presentation by a company called TransCanada, a big pipeline company. It's something of a progressive look. But we've seen things I've included it here because these projections have pretty much followed true. First of all, you can see the first takeaway is that gas demand is really picked up here, and we're talking about really very large numbers. But if you go back to 2000, we're roughly expecting North American demand to nearly double by the year 2025. That's a pretty astounding increase in supply. And this graph again shows you sort of where it's all going to. We're seeing more industrial demand. We're seeing a lot of fuel switching from, particularly in residences, from fuel oil, which is more expensive, it's dirtier, it's more dangerous, to natural gas as we see more gas pipelines connecting more and more people. And this is a trend that's going to continue. I know there were there was the tragic accident in Massachusetts that's caused an outage of the system from that distribution system for that company. But it's really, I think that's more a question, and I think we will see more upgrading of older pipeline systems. But this is a trend that does continue. And gas is just simply cheaper than the alternatives like fuel oil. But the big drivers here, I think, are going to be, again, LNG exports, and we're seeing more centers opening up on the East Coast. That most of what's been happening to date has been in the Gulf Coast area, but now we're seeing Dominion Resources, or Dominion Energy now, has started up the Cove Point facility off the coast of Maryland, and that's seeing rising volumes. We're going to see another facility opened by Kinder Morgan at the Elba Island facility in Georgia. And little by little, more and more gas is going to be exported. So that's a very big potential driver of gas demand in the U.S. And of course, the big one, which I talked about a minute ago, is electricity generation. Events like the tragic floods in North Carolina just recently, really illuminating some of the disadvantages, even more disadvantages of operating coal plants, as if there weren't enough already. And that is, in this case, the coal ash beds or ponds, basically, at this point, that because of flooding, the potential of ruptures and seeing material, leaking into water supplies containing levels of arsenic and so forth. Pretty big negative if you're a utility. So Duke Energy, like so many other companies, is accelerating its switch from coal to natural gas, which is, again, because of all the supply that's been unlocked by shale, remains cheap. So this is, again, driving a demand push, not so much for companies that depend on price increases, but we're even seeing a lot of companies, producers, do well in this environment if they're able to keep their costs down. So if they're able to keep their costs down, ramp up their production, they're doing quite well in this environment with more and more demand. Companies, on the other hand, again, that traditionally we've looked at, like in other environments, and particularly high price environments, companies that are really leveraged to higher prices, high cost companies, not such a great place right now. So the gas story is another pretty good illustration of why you really have to be selective in your picks, but it's nonetheless a very powerful argument for energy stocks and for our table pounding buy recommendation on this sector. Energy stocks are still lagging, and this graph is a comparison graph courtesy of Bloomberg. It goes back about 5 years, and what it shows you is the comparative rolling returns of three things. The red line is the S&P 500. Obviously, it's been a great year to hold a basket of common stocks, and that's reflected in the S&P's return over that time. Total return, which is dividends plus capital appreciation, of about 13.4% a year, or about 87% as of when I did this graph. So pretty strong return for the S&P 500, but opposite picture here for energy stocks. The white line is the S&P 500 energy index, sub-index, and that's composed of all the energy stocks that are in the S&P 500. So they tend to be pretty large companies, a lot of super majors in there, barely broke even over that 5-year period. And in fact, that's only because of a pretty stiff rally here just recently in a number of these names. If you look at the total return, about 3% for that index. That's the big oils. The other index that I'm depicting here is the yellow line, and that is the Alerian MLP Infrastructure Index. MLPs are master limited partnerships. For those of you who are unfamiliar, it's a structure, a corporate structure that enables companies to really pass through or avoid taxes, passing through a lot of expenses, passing through a lot of income to their unit holders, and it all kind of comes down to filing a K-1 at tax time. We're expanding our definition of midstream. So there was a time when most of the midstream business was being run through companies that were organized as MLPs. Now we're seeing a number of companies converting to corporations. So we've been adapting our coverage models to that reality. We do believe that there still will be MLPs, and there'll be plenty of companies that elect to keep that model. We think we'll even see eventually some more IPOs, companies that are converting to that model or actually are spun out of larger companies using existing assets and offering a pretty compelling total return to investors of income plus prospective growth. But this is definitely a change that we've seen. Companies like Williams companies
taking in taking in their master limited partnership unit. Enbridge doing the same. We don't believe this will happen to all MLPs, but it's definitely changed that universe. But this graph does give you a pretty good indication of what's happened to the MLPs, formerly a very hot sector of the business. And Elliot and I, in our former lives working for another company, we had a product called MLP Profits that did very, very well from about 2009 to about 2012, 13, when we founded Capitalist Time, when we left to found Capitalist Times. That was a very, very profitable part of that market. We benefited from that. There was a little tail as we started EIA. It's been pretty much a hard slog for that whole business, though, over most of the life of Energy and Income Advisor. I think we've, again, been able to keep our head above water by selling things, by being very, very selective about what we bought. But as you can see, the overall picture has been very, very weak for this sector, although perhaps a little bit of a comeback right now. The technical pictures are looking a little bit better. I think really the sentiment for the MLPs bottomed really back around May, when Elliot and I were at the annual conference put on by MLPA, the MLP Association. And it's a conference we've been going to for many, many years. It was this year, I would say, to put it mildly, a lot of gloom out there, a lot of questions asked about any company converting to corporations, for example. There was a ruling out there by the Federal Energy Regulatory Commission that was actually very negative, only for a very small number of MLPs, but it really kind of reinforced the gloom. So what we saw back at that conference was a real bottom for sentiment at a time when actually the technical picture was starting to improve. Certainly the fundamental picture has been improving for the last 6 to 9 months. Again, a pretty good indication of what I've been talking about with cycle changing and us being able to buy stocks looking better, in business, looking better on the technical side, having demonstrably bottom, but still that sentiment so negative, and giving us really a tremendous upside opportunity from that. So again, a very positive, bullish picture on the commodities, on the cycle. The stocks have not caught up. So that means opportunities, and I just wanted to give you a few, all of which that we explore in Energy and Income Advisor. U.S. oil producers, we're very bullish on this group. Not all of them, certainly, but the Permian Basin in Texas, the Delaware, the Midland, pieces of that, this is really where the action is. It's pretty much the hottest oil producing area in the world right now, which is really, again, quite shocking, I guess, for me, who grew up with that, kind of came of age during the Jimmy Carter administration, when it seemed like we were going to be importing more and more foreign oil, and America would always be dependent on particularly unstable areas of the world, or even hostile nations, to provide our energy. It's not the case right now, and again, it's really quite a bonanza that we've seen. Not just in Texas, there are other areas where activities really heated up in North Dakota and the Bakken region. The DJ Basin of Colorado also has a lot of potential there, but the Scoop Stack in central Oklahoma. But the bottom line is that we're really pushing ahead in this business, and there's a lot of really exciting plays among U.S. oil producers. Certainly not a place to indiscriminately buy. Some valuations were quite high about a year ago, come down quite a bit, so that's not really such a problem. But again, it's very much a basin-centric, and I am going to show you a couple of slides at the end of towards the end of this presentation that kind of make this point. Plays that are companies that are really plugged into natural gas demand. I'm actually going to give you one of these as well as a kind of a pick for this webinar. But companies that are benefiting from more LNG exports, from more use of energy by U.S. utilities, from more demand for natural gas in Mexico. These companies are getting more business as this traffic picks up. They actually do better. The traffic actually, there's a good argument to be made that traffic picks up as from prices remaining low, and so it kind of puts them in a little bit of an opposite place in terms of interest, self-interest from other or from the natural gas producers. But this is an area where we think there's a tremendous amount of upside. It's also an area where we see a tremendous amount of value. A lot of these companies have been and still are MLPs. Some of them have converted, and there has been a fair amount of carnage in this space. A lot of companies that expanded maybe a little too fast, maybe lost a few key contracts, maybe were a little bit too leveraged to prices and were hurt by lower gas prices over the past few years. But we've seen distribution cuts, so we've seen investor sentiment really kind of shift negative on natural gas. So there is quite a bit of value there if you know where to look. Super majors. Elliot and I actually have just completed an issue of Energy and Income Advisor on this group. These are the big oils. These are the companies like Chevron, like Exxon, like Royal Dutch, like companies that really control not only their production, they don't and do so all over the world, but also have downstream operations in refining and in chemicals and even distribution. You see a number of these companies investing in other areas too right now. Liquefied natural gas infrastructure, for example. Some are investing in renewable energy. Kind of the hallmark is that they make it through almost any market environment. This is probably the highest valued group in the energy space right now. They didn't go down nearly as much as the other energy companies did. And so therefore, perhaps not as cheap, but we do see quite a bit of value there. And Elliot and I have just done an issue of EIA. Will be coming up in the next couple of days that highlights our view on the major issues there, highlights some of our top picks. But this is another group. And if you're really conservative, this is a great group to get involved with. I've had one of the companies in this group I've owned really since I got out of business school. I can tell you, literally, I've owned it through the dividend reinvestment plan, so my dividends have continued to buy more shares. I'm literally making more money in the dividends that I get every year than I initially put into the stock. I think there's going to be more of this going forward. I think it's an ideal savings vehicle. I'm very excited about this group. I tend to get excited about more conservative things, perhaps, than others do. But this is, I think, again, a group with tremendous value, and we do cover it on a regular basis in Energy and Income Advisor. Efficiency in data companies. Energy is really the last frontier in terms of using of digitization. In other words, looking at processes and trying to make them as efficient as possible by finding ways to gauge various inputs and outputs in a more efficient way. These are things like using drones in terms of monitoring safety and so forth, and large equipment to cut down on accidents. Things like monitoring the input, the heat rates of all sorts of things. And this is an area where energy companies can become tremendously more efficient. And we've identified a number of very smaller plays. We put these companies in the services space, but we've identified a large number of the better ones that we see out there. We also like some of the larger ones in the energy services space at this point. It's a group that is kind of at low ebb in terms of sentiment, but definitely due for an upsurge. Things are looking up for this business, which is streamlined, focused on where the activity is, and as a result is really tapped into where things are happening in a big way. Water is another area that kind of fits into this, and this is the fact that when we do more hydraulic fracturing, two big elements that you need. You need a lot of sand, and companies are finding ways to use local sands as well. But kind of the biggest one is water, and the way that a lot of hydraulic fracturing has been done to date has been just basically to truck in water, use it, and then truck out the wastewater and dump it into a disposal well somewhere. Tremendously expensive process, as you can imagine. I mean, water's hugely, very, very heavy, and takes up a lot of space, and a lot of this byproduct wastewater from the fracking process is quite filthy, quite dangerous. In fact, there are examples of disposal wells being struck by lightning, catching on fire. The earthquake situation is another big problem, and this isn't caused by the actual fracking process. Again, it's caused by the dumping of water into disposal wells that are located in geologically fragile areas. So, take a look at the incidence of earthquakes in Oklahoma, going up basically 1,000-fold recently as more volumes of wastewater have been dumped. The solution around this is recycling the water. And in fact, recycling technologies right now, and the company I'm going to give you is actually very big in this business. Recycling technologies right now, though, enable companies to basically cut their overall water cost by about 80%. So that's turning a huge line item into actually a fairly modest one. They also ensure that there's always going to be a water supply there, because you don't have to truck it in from some other source or procure it. You've got this water coming, and it's also water that's more reactive and potentially more reactive to the resource. In other words, more able to because it's you can change the chemistry and you can make it more like the water that's naturally in that space. You can actually make increase the yield, increase the energy coming out. You can some of the wastewater includes usable resource, so that can be resold. But I think probably the biggest way that this thing cuts down on costs is just that it eliminates all this transportation that's needed. So this is a huge area of growth for this business. As one guy I talked to said, well, it puts us on the side of angels, but it also, for the favorable environmental factors, but it also is a great way to save a lot of money and drive down your costs further and be able to produce more resource. So very exciting area, this efficiency and data side of the business. Selected energy fixed income. We do recommend from time to time bonds of these companies. Our rule on bonds is that we don't want to own a bond of any company that we wouldn't want to own the common stock. We want to own a bond if the company is getting stronger as a business, and that's really the bottom line for these companies going for anything we're going to recommend going forward. But we have found some pretty good fare out there, and we do feature this from time to time in Energy and Income Advisor. And then finally, around the world, Australia, Canada, Mexico, Argentina. Argentina actually includes right now a field that many people will believe will be the next Permian Basin. And their government, unlike in past years, is now pretty pro foreign investment. So this could really get done, could do well for a number of companies. Australia and Canada, these are, I've been following companies in these countries for really since early in the previous decade. They tend to come in and out in terms of being attractiveness. Australia is a very big LNG center at this point, so that's where we've kind of focused our efforts. In Canada, the big thing right now is just a lack of off-taking capacity, a lack of transportation capacity, and that's for all sorts of, that's for oil certainly, and we've seen that exacerbated by the fact that Canadian companies have tried to build a number of pipelines. They've been pretty much stymied in every case. But also it's true of natural gas because you're producing a lot of gas in Alberta, also north east British Columbia, places like the Montney Shale, that there's just not the transportation capacity to get that out. And those areas are quite prolific. So therefore you have gas prices often cutting down even under $1 per 1,000 cubic foot. Huge discounts to U.S. energy. Same thing with oil. Sometimes you've had oil prices selling at 30 and 40% discounts in Canada to what it sells in the United States, simply because transportation. So this is a huge issue. Obviously, at some point, and we're already seeing it with gas and with natural gas liquids, which are come out of natural gas, things like propane, ethane, and so on. Canada is becoming a huge producer of those, and now we're seeing a number of companies developing infrastructure that will allow them to get that energy out, selling to the United States or potentially selling to Asia. That's really the big potential market for Canadian energy. If you look at the distance, the difference in distance between Asian markets and the coast of British Columbia, and what has to happen to get energy through the Suez Canal and so forth, you're talking about a massive savings in terms of the number of days of shipping. So that's a huge advantage for them. It's an opportunity we're looking at. Mexico, again, a very interesting country that I think nobody really knows what is going to happen when the new president comes in, and he's definitely talked a lot about changing energy policy and so on. A lot of course, when anybody starts talking about that, there's a lot of uncertainty. I think there is actually a pretty good chance that this becomes a very, very bullish opportunity for companies doing business there. We have a couple of plays that we like there. So a lot of high energy opportunities there, and that we're following up on in Energy and Income Advisor. And this is us, Energy and Income Advisor. I'm the guy on the right. Elliot's the guy on the left. And this is our publication about energy. Again, it's been around since towards the end of 2012, so which is really a lifetime in this business. But both of us have we go much further back in terms of energy. And again, we're excited to bring our perspectives to your attention. Between us, we have about here's a few more points on who we are. Between us, we have 50 plus years of combined experience advising on energy stocks. I think that's really kind of the most valuable thing I guess we bring to the table. We definitely spend a lot of time looking at individual companies, and we do have pretty large coverage universes of MLPs, foreign energy companies, as well as producers, service companies, all across the board. And we spend a lot of time looking at them. But I think having a perspective of how things have performed in other markets, how investors have reacted to different things in different markets, very important with this, I think, in terms of keeping a level head. And when you are investing in a business that is starting, again, in that commodity price cycle, going back to that first slide, you're in that bottom left-hand quadrant where things are just starting to get going. You can have some pretty shocking reversals along the way to things moving higher. So, which can frankly unnerve people. And that's, I think, one of the big things we bring to the table is just that kind of perspective. I will not even take credit for this call, but Elliot back in 2014 made the call that he thought oil prices would head down as low as $25 a barrel over the next couple of years. As it turned out, we got $26 and change. I think that's a pretty good call. We've also been on the right side of the recovery so far, as I pointed out. Even though sentiment's been bad, technicals have been recovering, and a number of the companies that we've been talking about have done actually very well over the past several years. So tooting our own horn, I admit it for now, but I think this is fairly, I think this is actually the reason why we're still, putting an energy publication together, even through this very vicious cycle where a number of companies had to fold their doors, and a lot of The number of energy analysts on Wall Street has shrunk. The percentage of energy stocks in the S&P 500 has shrunk very dramatically, very, very close to a low. So it hasn't been easy, but I'm really proud of our record doing that. We do have unmatched sector coverage up and down the energy value chain. That means that we cover everything. And if an investor, we do have these monthly chats. I'm going to talk about one of those that's upcoming very shortly. You're free to ask pretty much any question you want, and often we've discovered and identified companies because of that, and that we picked up later for coverage. So we do cover everything. Many of these companies we've covered for 20 years or more. So again, getting back to that perspective, we've seen what's happened with their stocks. We've seen what's happened with their underlying businesses. We've seen their progress or lack thereof becoming more valuable places to build shareholder wealth. But again, we cover everything. We condense everything down to a managed portfolio. This is a feature I think it can be actually bewildering when you look at a broad universe. You look at so many companies, and we do cover all the companies we cover in our coverage universe. We provide buy, hold, sell advice, as well as safety ratings and so forth. But we do want to condense all that down to something, the best of the best, and we want to show you how much you should own of each of those groups. So this is our actively managed portfolio. We have condensed actually larger groups of portfolios down to this one group, and again, we want to keep it simple for you. You can use Energy and Income Advisor any way you want, of course. You can buy stocks that are off the main portfolio, but we do have, again, a concise managed portfolio, so you can see exactly how we think we think you should do it. I know a lot of people, in fact, most of the newsletter advisories that I've worked on have basically provided lists of stocks with the implicit recommendation that everything is evenly balanced. Well, I know that's not the way it works. I have my own portfolio. I know that when stocks go up, they become bigger parts of your portfolio, and so on. So, just putting a percentage in there, not necessarily a fair way to rate things. This is actually a way you can see how we're doing, and if our advice is paying off. So again, a nice feature of this product. We really take all this stuff that we cover, all this broad coverage, condense it down into something that's easy to follow. Last item I just want to bring up is early warnings on dividend cuts. This is actually a fairly new feature to Energy and Income Advisor that we've had in other advisories like Conrad's Utility Investor. But I think it's already proven to be pretty valuable. We've had about half a dozen. We provided early warnings on about half a dozen distribution cuts this year. I think we're going to see more. I think this is a very valuable piece of the newsletter. It's also a pretty good illustration that not every energy company is worth your dollars, and it's why picking individual companies is so much more rewarding than buying ETFs.
I hope you found this video presentation to be informative. Now is the time for you to act upon one of the best opportunities in energy that we'll ever see. I'm talking about Energy and Income Advisor, and my co-editor and publisher, Elliot Gue, and I have come up with an offer to make your next step an easy one. Join us today with a 1-year charter membership at Energy and Income Advisor. Receive our twice monthly issues and timely alerts, our 5 new reports on the best plays right now up and down the energy value chain, and access to our monthly subscribers only online chats. As an added bonus with this membership, we're also offering a complimentary 3-month subscription to our multimedia investment advisory, Deep Dive Investing, highlighting the best opportunities across the investment waterfront and a $500 value. And now, a word about our guarantee. We're so confident in our work that we'll refund all of your money anytime during the first 60 days of your subscription if you're not completely satisfied. In other words, if Energy and Income Advisor doesn't perform for you by the time you're sitting down to eat your Thanksgiving dinner, we'll happily refund every dime of your membership. It's as simple as that. Give us a try. We take all the risk. All you have to do to get all your money back is to call us by the 26th of November. We also promise that so long as you remain a subscriber in good stead to Energy and Income Advisor, you'll never pay more for your subscription than you pay right now. That's our forever guarantee, and we stand by it.